Like the idea of having your cake and eating it too? Want to see your wealth and your passive dividend income increase exponentially? Would you like to know which high yield stocks to avoid and which stocks to potentially consider instead? Then you have to check out today's video.
He is a best-selling author.
30-year-old Jason Fieber has a plan.
This guy retired at only 33 years old.
I don't know if I know too many people that have accomplished something like that.
He's really kind of a guru when it comes to passive income.
Before I get into today's content, please give us a big thumbs up if you find value in our videos. Helps us to get the word out and grow the channel, and I'd really appreciate it. I've made a ton of videos covering a very simple concept that I can't seem to hammer home. Don't chase yield. I don't think I can say those 3 words enough. Despite my best efforts, we get comments left and right about high yield junk stocks. Patience is a virtue. It requires patience in order to see the compounding process play out over time. If you invest in high quality dividend growth stocks, you will likely see your wealth and your passive dividend income increase exponentially over the long run. Now, it takes time for that to happen, but I am talking about total returns that can beat the market and dividend growth that can beat inflation. So it's having your cake, wealth, and eating it too, income. High quality dividend growth stocks are like the golden geese that lay ever more golden eggs. But high yield stocks that can pay out a lot of income right now without requiring that whole patience thing, those high yield stocks entice a lot of naive investors. Today, I'm gonna share with you 2 high yield stocks to avoid and 2 high quality dividend growth stocks to consider buying instead. Ready? Let's dig in. The first high yield stock to avoid is AGNC Investment Corp, stock ticker AGNC. AGNC is a real estate investment trust that primarily invests in residential mortgage-backed securities. This is a classic high yield trap that ensnares unsuspecting investors who look at the high yield and get all starry-eyed. But here's the thing, AGNC has been a terrible investment for as long as I've been investing. This stock yields a monstrous 9%. Awesome, right? Wrong. The yield only looks great because the stock continues to head downward year after year. Price and yield are inversely correlated. All else equal, a lower price will result in a higher yield. So high yield stocks almost naturally tend to be limited to the worst performing stocks. This stock has declined by almost 20% over the last 5 years alone. During one of the most robust 5-year periods of the entire US stock market's history, this stock goes down. I mean, if that doesn't tell you to stay away, I don't know what will. Meanwhile, they continue to cut the dividend left and right. The current dividend is 40% lower than it was in 2016. Investors who bought this stock 5 years ago have seen the indignation of seeing both their wealth and passive dividend income drop severely. That is a no-go. Instead, consider buying WP Carey Inc., stock ticker WPC. WP Carey is a real estate investment trust that owns over 1,000 properties, primarily in the United States and Europe. While AGNC is dealing in mortgage-backed securities, which is a giant can of worms in and of itself, WP Carey does things the old-fashioned way. We're talking about physical real estate here, which they buy and then net lease to quality tenants. Everything from storage properties to government offices. This stock yields 5.2%. No, not as high as AGNC, but what do you get in exchange for giving up some yield? Well, safety for one thing. The current dividend is handily covered by adjusted funds from operations. And how about solid long-term investment performance and the growth of your passive dividend income? Whereas AGNC is down by almost 20% over the last 5 years, WP Carey is up 17% over the last 5 years. Would you rather lose wealth or gain wealth? Not a difficult choice, really. Meantime, WP Carey has increased its dividend for 24 consecutive years. The dividend is up by almost 7% since 2016. High-quality dividend growth stocks like WP Carey grow shareholders' wealth and give them growing dividends, while low-quality, high-yield stocks destroy shareholders' wealth and give them shrinking dividends. With a price to cash flow ratio of 16.6, this stock remains reasonably valued. And real quick, before I move on, WP Carey is one of my top 5 stocks for 2021. Another high yield stock to avoid is Prospect Capital Corporation, stock ticker PSEC. Prospect Capital Corporation is a business development company that makes debt and equity investments in middle market businesses. Like moths drawn in by the light of a flame to their own doom, some investors find themselves drawn in by super high yields to their own financial detriment. PSEC is a classic example of this. This stock does yield a mouth-watering 8.8%. And that's pretty much where the appeal begins and ends. This stock is down 2% over the last 5 years, even while the US stock market doubled over that stretch. Anyone who bought PSEC 5 years ago picked up some nice dividends along the way, but they were seeing their wealth destroyed in the process. Adding insult to injury, this stock's dividend has gone down over the last 5 years. The dividend was over 8 cents a quarter per share in 2016. It's now at 6 cents. Their 28% dividend cut in 2017 has never been rectified. Yield chasers got attracted to the roughly 12% yield the stock offered in 2016, but all they ended up doing was missing out on big gains elsewhere, all while seeing their dividend income drop. It's the worst of both worlds. Instead, consider buying Main Street Capital Corporation, stock ticker MAIN. Main Street Capital Corporation is a business development company that makes debt and equity investments in middle market businesses. Yep, another BDC, except Main Street Capital has been run significantly better over the years. I looked at both PSEC and Main years ago for an investment in my own portfolio. At the time, if I recall correctly, Main yielded about half that of PSEC, but I still chose Main because it appeared to be, after my research, the much better business, and I'm glad I chose wisely. This stock is up 21% over the last 5 years. All that stock performance while also spitting out a big fat dividend that's been super reliable and has increased regularly. I couldn't imagine sleeping well at night owning something like PSEC, but Main is a stock that has never given me bad dreams. No, it doesn't yield as much as PSEC. It didn't when I bought it, it doesn't now. That's partially because it performs much better and doesn't pay out a bigger dividend than it ought to, but it does offer a juicy dividend that is supported by distributable net investment income, and this yield still smokes the market. The yield on this stock is a very nice 5.9%. That's more than 4 times higher than the broader market's yield, and the dividend is paid monthly. Plus, you're getting solid business performance, stock performance, and dividend performance. It's been said that the safest dividend is the one that was just raised. Well, Main has increased its dividend for 11 consecutive years, with their most recent dividend increase coming in only days ago. The dividend is up by nearly 17% over August 2016 levels, with most basic valuation metrics below their respective recent historical averages. Main's valuation looks sensible. If you like lighting money on fire, be my guest and chase yield. But if you want to do well over the long run, stick to high quality dividend growth stocks that will exponentially grow your wealth and your passive dividend income. Thanks so much for watching. I hope you enjoyed today's video. Give us a like if you did, and let us know in the comments what you think about these stocks. Please make sure to subscribe to the channel and ring that notification bell so that you don't miss out on new content. Also, take a look at the description box below for some important links, including a link to my personal stock portfolio. This 6-figure portfolio, which I call the Fire Fund, generates enough passive dividend income for me to live off of. It allowed me to retire in my early 30s. I've made my portfolio entirely accessible over a Patreon, and I also post alerts there whenever I buy or sell a stock. I put my money where my mouth is, and I'm often invested in the same high quality dividend growth stocks that I make videos on. Over the years, I've heard from thousands of investors who have been profiting from many of the same exact stocks that I own. So if you think this is something that you could benefit from as well, check the link in the description to see my portfolio and start getting my buy and sell alerts. I'll see you next time.